Good afternoon, everyone. I'm T3 Live Editor-in-Chief John Darcy here to bring the daily recap. This daily recap is actually being shot at around 3:10. We had to shoot it early for technical reasons, but just giving you that disclaimer before I jump into the action. So we're not going to get closing prices here on stocks and indices, but prices as of about 3:10, 3:15, depending on how far into the video I talk about it. But just when traders thought the action couldn't get any more difficult or any more head-scratching, we go and we have a day like we had today where I think traders are really starting to get to their into their rope here with some of the action that we're seeing in terms of lack of follow-through, extreme volatility on a short-term basis that's shaking people out of trades and not allowing them to hold any sort of size or any sort of very many positions at all without extreme volatility, like I said, shaking them out of these trades and really causing a lot of anxiety if you're trying to hold things. And as I'll look into some charts in a second, but you just take a look at the chart of the S&P first of all, and I'll look at the NASDAQ in a second, is we opened pretty sharply higher because of those Facebook and Apple earnings that we had after the close yesterday. But looking at the daily chart, you might not see it as clearly, but as you can see, we made a low of the day, a pretty sharp sell-off. It looked like it was going to potentially be an engulfing day early on. We've been able to bounce from there, and we're actually just around the flat line right now. But you take a look at the 5-minute chart, for example. Let me go to just the intraday time frames. Look what we got on the open here today. Yesterday we got a pull in to a slight pull in to work off a little bit of our overbought condition after a 6-day rally in the S&P. But then immediately we got a gap up this morning on those positive earnings and that news. But then you got this huge down move in 3 5-minute bars in the morning that shook people out of any long positions they might have been holding, I think, and even more extreme moves in some individual stocks, which I'll talk about in a second. Some of it was, geopolitical news. There was some stuff that hit about Russia and Ukraine and not backing down and everybody talking tough over there in that region. But I think all that's just noise from the market. But it's just this type of volatility that we're seeing on an intraday basis and then lack of follow-through we're seeing on a swing basis is just creating an environment where traders are just pulling their hair out. And luckily, I still have hair because I don't really day trade, but I think that's probably saved me quite a lot of stress here, especially over the last few weeks. But just again, not an environment where I think experienced traders are not being very aggressive right now because they recognize this environment. And I think that's one of the reasons why they are experienced and why they've had long careers in the business is not only do they avoid big losses in terms of their P&L during frustrating times like this, they also keep their stress level down. And I think that helps lead to longevity and it helps you maintain your confidence and your conviction and ideas. But like I said, we were able to rebound from that early selling. We're sitting here around the flat line now, but definitely not healthy action. And when we look at some moves that we've seen in individual stocks today, it'll reinforce that notion that the action has not been healthy whatsoever. And then this morning in the morning call, I talked about how the NASDAQ, we're still on the 5-minute chart here, the NASDAQ was a lot stronger because obviously Apple's the biggest component in the NASDAQ. And then you had Facebook also came out with really strong earnings. The NASDAQ opened about a 1.5% higher this morning. And in the span of basically 30 minutes here in the morning, we filled that entire gap with just really sharp selling. Like I said, there was some geopolitical stuff thrown in there, but no matter what the input is, as long as it's not nuclear war or something like that, to see that type of gap filled that quickly is not altogether constructive action, but the market has, over the course of the last few years or so, shrugged off a lot of stuff that's not constructive action. So on one hand, you're seeing a lot of continued warning signs in the market, but the market has just remained resilient over the last several years, so it's making traders hesitant to jump in and short rallies like we've seen. But I still think that is the proper mindset right now. I think there's so many signals under the hood, something we keep talking about, that tell you that shorting rallies right now is definitely not a bad idea, especially in stocks that show relative weakness. And as I've talked about before, balance your book with some strong stock, with some weak stocks. This is a look at the daily on the NASDAQ. As you can see, that big tail that we're forming after that big down move in the morning. If it can hold higher, maybe it can push a little bit higher, but a lot of cracks in the foundation there. And let's jump into a couple of those earning stocks. So before I jump into the chart of Apple, I just want to say a couple things about the way I interpreted that earnings report last night as someone who doesn't own the stock. I think anybody tries to justify their viewpoint based on whether or not they own Apple or they are Apple bears or they don't own Apple. And I think the people who own Apple interpreted last night's earnings report as great earnings growth, great iPhone sales numbers were higher than expected. The 7-to-1 stock split, I've been waiting forever for that to happen. Finally, it's less capital intensive. It's going to welcome in a new class of investors. The repurchase program, the share repurchase program, and the dividend increase, those are hugely positive things. This is going to set the stage for Apple once it splits to get back to the $100 level, which would coincide with the $700 level and previous highs and stuff like that. But on the other side of the coin, and I do agree with some of the things in the first part of that, don't get me wrong, but on the other side of the coin, I also think some of the stuff that Apple came out with last night smacked of a little bit of desperation to me, and it smacked of a company that isn't able to drive itself on innovation and actual concrete growth as much as it's trying to drive itself on announcements of something like a stock split in particular. I think the stock split's the only thing I really have a gripe with. The iPhone numbers were good. iPad numbers were not good. The iPad and tablet market has a lot of question marks surrounding it right now, whether or not it really has a big future. Phablets, the phone-tablet hybrid seems to be what more people are interested in right now, and we'll see more on that later this year, hopefully from Apple with their new phones. But in the share repurchase program, the dividend increase, I think that's all great stuff. Apple's transitioning from being a huge growth stock to being a value stock. But the 7-for-1 stock split is the one that really gets me. And 2 years ago, Tim Cook came out and basically said, amid this flurry of people talking about how Apple should split their stock and welcome in a new class of investors and unlock some hidden value there with the stock split, he came out, and I agreed with him when he said it, the stock splits don't really do anything for shareholders. It's more inconsequential than people realize, and it's much is made of cheaper stocks. There is some evidence that supports that cheaper stocks might perform a little bit better, and maybe the stock split was done to make it a price that's more, it will be easier for it to be incorporated into the Dow. There's a lot of articles about that. Who knows, maybe that's their motivation for doing it. But he said 2 years ago that stock splits are stupid. There's no reason to do them, but they don't unlock anything for shareholders. And then he comes out last night in their earnings conference call, talks about how a 7-for-1 stock split is going to usher in a whole new class of shareholders for Apple because it's less capital intensive, and it could be a great thing for investors and a great thing for Apple. And obviously those things are very contradictory, and both of those opinions are very self-serving. And for me personally, there's always been a lot of criticism surrounding Tim Cook. Tim Cook has gotten a lot of criticism for not innovating and not having the PR chops that someone like Steve Jobs had, and not having the innovation and the vision that someone like Steve Jobs had. But me personally, I've always given Tim Cook a pass, rather, because I felt like behind the scenes, Apple is just a very calculated, measured. They don't try to be flashy, and they don't leak product announcements, and they don't talk about something before they release it, because they know that when they do release it, they're going to do a good job with it. It's going to be a good product, and it's going to speak for itself. They haven't had to do things like stock splits in the past and do things that were flashy and really pump their stock the way some other people do. But this announcement last night of this stock split and him doing an about face on the value of stock splits sort of throws that out the window for me, and it's been the first time I've really questioned whether or not Tim Cook is actually equipped for this role. And I was hoping that Apple would speak for themselves and they would release an iPhone 6, a bigger phone later this year with improved specs and catch up to some of the things that Android is doing and that these Samsung phones are doing. But the fact that they went out of their way to do this last night with the stock split definitely makes me question that and makes me a little bit skeptical of Apple's future, which might be ironic considering the fact that it's up around 8 or 9% here overnight and it's holding up today. But that's enough of my rant on Apple. Let's get to the charts a little bit, because opinions don't get you paid. Price action gets you paid. So let's take a look at Apple here. Apple, big gap up this morning, and you talk about that weakness that came in the NASDAQ. It wasn't really Apple's fault. I mean, you can take a look at the 5-minute. There was a little bit of selling in Apple, but overall, very muted compared to the sell-off that we saw in the NASDAQ in stocks like Facebook, which I'll get to in a second. And this will be very constructive to see Apple close here. A little bit of a tail, but to see it close above the earnings gap, given how big that earnings gap is, that's hugely constructive, and that tells me Apple wants to go higher here in the short term. Obviously, this 575 area is going to be the next huge challenge for Apple to see if it can break out to new 52-week highs. And if it can, and then split adjusted, do I think it can get back to highs? Yeah, I do. I've always thought Apple's undervalued. I've talked about that many times here on videos that I've done here. I think I love value stocks. I love stocks that are buying back shares and cannibalizing that share count. I love stocks that are increasing their dividend and returning cash to shareholders. And I think it's great that Apple's transitioning to be more of a value type of stock, but I do think that when push comes to shove, the middle to end of this year, when they release these new iPhones and any other products they're looking to release, that's when things are really going to be decided with Apple in terms of its future and how people perceive it going into the future, because I think things like a stock split, things like share repurchases and dividend raises can have a short-term and a gradual effect on a stock price, but I think it's really going to take proof that they are innovating and still an innovator for it to really ignite. But technically speaking, really constructive action. I could see it, if nothing else, be more in play from a short-term trading perspective, whereas it's been sort of dead money over the last several months as it's been in that wedge pattern. Anyways, Facebook, and I talked about that weakness in the NASDAQ, and the Facebook was a poster child for that really extreme volatility that we saw in the morning. Obviously, Facebook came out with some solid numbers again. Their mobile ad revenue continues to grow and accelerate even. It's 60% of their total revenue now, which is a complete 180 from where they were a year or so ago. So they've done a really good job with mobile, and they haven't even started to monetize their video ads that they're talking about becoming a big part of their lineup. So a lot of opportunity, I think, still for Facebook as they continue to see their user base grow. But it erased all of yesterday's losses, which were pretty considerable. I guess people weren't expecting great earnings perhaps for Apple, or for Facebook, excuse me. But it erased all those losses. But then in the morning, look at this 5-minute chart on Facebook in the morning. Big gap up of around 5%, and just in 3-4 down bars, it was suddenly down 4%. So extreme volatility there. Doesn't exactly breed confidence. And whereas Apple is holding above its earnings gap and even maybe pushing higher, Facebook is not. So maybe tells you it's a little bit tired. And then you're seeing these other moves that we saw in social media stocks today. It would tell you that there continues to be a little bit of skepticism about the social media sector. Look at Twitter, for example. Some people were thinking Twitter, and it gapped up on that Facebook earnings news. But Twitter, even more extreme weakness, and didn't get a green bar until 5, 10, 15, 20, 25, 30, 35, 45 minutes into the day. So really 7 really potent down bars. Some of them weren't as potent as others, but it was down huge and was able to bounce really strongly as well to get back and pare some of those losses. But you look on the daily chart, that's a big engulfing bar that tells you Twitter wants to head lower. Obviously, a lot is going to be determined by Twitter earnings, which are coming here soon. So I wouldn't, get into a long-term short swing position based on today's engulfing bar just because earnings are coming up. But this definitely doesn't breed a whole lot of confidence about the way institutions and big players in the market are perceiving social media right now. You look at LinkedIn, another one, big engulfing bar, a little bit off of its lows, but still a really ugly candlestick there. Yelp, just falling off a cliff below its 200-day moving average. This pivot's going to be obviously really important here around 58.81. So we'll see if that holds up. Another one that was weak today in that media 2.0 type group. And then this one doesn't really fit in that category, but just another example of the crazy moves that we saw this morning. Zynga, similar chart to Facebook. It's very tied to Facebook, so you'll see some of the price movement be somewhat similar, but just extreme weakness this morning in Zynga. Gapped up big, but then in one bar basically went flat and then continued lower, and just overall is really weak. I just wanted to show this as an example of some of the crazy moves that we got today. I wouldn't even touch Zynga with the 10-foot pole, but just something to talk about. And then some other weakness in some other high beta tech names. The one I'll really focus on is Netflix, and this is one that I'm concerned about definitely from a longer term perspective, given all the competition that's coming in, and then technically the fact that it didn't hold that earnings gap because of the news that came in about the HBO-Amazon deal, and just the ongoing news about competition coming from Amazon is the leading competitor right now with all the stuff they're doing with their streaming services. But then also Apple talking about a deal with Comcast, and a lot of companies identifying streaming services as a potential opportunity in the future that they want to take advantage of is really hurting Netflix right now, and I think it might give way at the 200-day here sometime soon. This morning in the morning call, in the trenches section, if you're a subscriber to Scott Reller All Access, I talked about the cloud stocks and security stocks that sort of fit in that category, big data stocks as well. And those are ones that I thought, based on some of the action we saw yesterday, weak earnings in VMW that led to a gap and go to the downside, and then just some of the overall action we've seen on a longer term perspective in that group, told me that these are in really big trouble right now. And I think Another factor that's in play is the Supreme Court is right now hearing the case about Aereo, the well-publicized case about their service, which is basically they house big server rooms with tons of little antennas that allow individuals, consumers, to basically purchase one of their antennas, which as a consumer you're allowed to do for free. You're allowed to erect an antenna in your home and pick up all the standard local TV channels like ABC, NBC, Fox, and all that. You're allowed to put that in your home. So basically what they're arguing is that you're allowed to buy an antenna and basically house it at Aereo's data centers, and you're allowed to pick up and record some television channels that way. And so that's the argument that Aereo is making in the Supreme Court for why their service should be allowed. But if the Supreme Court actually rules in favor of these big media companies that have brought the case against Aereo, it would be a huge blow for the cloud computing sector as a whole, because of what Aereo does is basically it's one big cloud for media that allows individuals to store on their own, basically on their own antenna and their own cloud, but it's basically the same concept as cloud computing. So what people have been talking about is how if the Supreme Court does rule against Aereo and in favor of these big media companies, it could be a huge, huge game changer in terms of the legality and the way these cloud computing companies work. And so I think that could be a factor in some of the sell-off that we're seeing, and also some of the weakness that we saw in earnings, like something with VMware. You look at VMW. This was what I think led to some of the weakness yesterday. Huge gap and go to the downside. It's actually been able to find some of its footing today, but still weak overall from that gap. It'll have to start entering that gap if it wants to avoid potentially going lower. And then some of the other names I talked about this morning in the morning call, if you get the full one with Scott Ruther All Access, was Workday, one that could be forming a little bit of a bear flag type pattern. Yesterday it was weak with a gap and go to the downside, and then today, talk about extreme weakness in the morning. Look at that. Look at that huge 45-minute decline that we saw, like we saw in a lot of stocks, but extreme selling in Workday there. And maybe that has to do maybe with a little bit of that Supreme Court case, who knows. CRM, another huge name in the group, cloud name, has bounced a little bit off its lows, but huge extreme selling in the morning. That is not normal orderly selling. That is really intense selling there that we saw in the morning there. And then on the daily chart, obviously the 200-day held once in early April. We'll see if it holds again. So far today it has, but we'll see what this leads to. And then more on the security side of things, FireEye falling off a cliff here, just continues to be extremely weak. Started with this king and queen here, and then it's just bled lower. And then yesterday, sort of like a miniature king and queen, and then breaking below pivot lows. A little bit off its lows of the day, like you're seeing with a lot of stocks today, but definitely doesn't look healthy at all. Has some short interest. People might look for some calculator reversal type setups, but on a swing basis, these look like they're headed lower. So just more examples of the crazy action we saw this morning. And while we're on crazy, might as well go to the airlines. On the daily chart, it looks like a tail. Tails form for different reasons intraday, but some of the short-term action that we're seeing, if you're trying to day trade these stocks and trying to protect your risk at all, this is not one that was really weak off the open. I mean, it was weak off the open, but the real extreme action happened around 11, 12 o'clock today in these airlines. Look at this. Look at these two down bars in American Airlines, which reported earnings last night. Extreme red bar right here, potent wide range. Another one, but during this 5-minute bar, we were actually able to bounce and reclaim some of those losses, and then actually took out the highs of the day briefly before sort of settling back into the range. And what do you know? Now it's around flat. So while the whole market has been not really going much of anywhere, and some stocks have not really been going anywhere at times, the intraday volatility is such that it's so hard to trade right now that risk outweighs reward in so many situations, and it's a losing proposition in my opinion. And then United Airlines, weakness overall today, big gap and go to the downside. So the transports, which have been pretty strong overall, United Airlines, definitely one that could be a harbinger of some weakness that could come in that group. While we're still on crazy, let's go to Biotech. I'll look at the IBB first. That's just the ETF. You're seeing a big tail in the morning. As you can guess, there was extreme selling off the open that eventually we paired some of those losses and are getting back up near the flat line. But again, not orderly selling, not what you want to see in a healthy market. Look at these 4 down bars for the IBB. And let's just jump into Gilead, why don't we? I talked about that in the morning call this morning as one of my quick hits. And I'll first start with the daily chart here. Basically, my point with Gilead is they reported blockbuster earnings, huge beat on the top and bottom line, but a lot of that was attributed to Sovaldi, their hepatitis C drug that's been very controversial because of how expensive it is. There's been hearings in Congress and talk from regulators about how they want to try to find competition for this drug because of how outrageously expensive it is. Given the fact that that was so important to their earnings beat and the rest of their drugs actually lagged a little bit, it's led to some skepticism here, and you got some really extreme selling intraday. We'll go back to that 5-minute chart. Extreme selling in the morning to take it sharply negative, but it's actually rallied basically back to around flat. So improving its composure a little bit. We'll see if this tail leads to any sort of bottoming type action here, but definitely a murky future here for Gilead despite a huge quarter. It's one that is one of these large cap biotech names that doesn't have quite the risk that the small cap biotech names do in terms of relying on one drug to basically produce all of their revenue. So it's one that I think could head higher in the future, but I would wait for things to calm down a little bit in the biotech group. We did see a nice basically 2-week bounce in IBB and in the biotechs, but still a lot of question marks there and a lot of crazy action. And then Celgene reported earnings last night. Another one that it was a gap and go to the downside that looked really potent there for a little while, but was able to bounce. It wasn't a really bad report. They actually beat on the bottom line. Their EPS was better than expected. There were some tidbits that people nitpicked at in the report, but to see that type of weakness on what was not a horrible report, definitely a bearish sign. And technically, this thing retested its 200-day and got rejected. So seems like it could want to head lower, and it's another one of those reasons why biotech to me right now is a little bit sketchy. And then the more important thing is if you're looking to be a buyer in this market, you don't want to just, I think, be buying indices or buying most sector ETFs right now. I think what you want to be doing is trying to identify a handful of relatively strong stocks that are acting well. If you want to do pairs trades and short some of the weak ones and buy some of these ones that are holding up, you can do that. Or if you just want to have long exposure, you just buy some of these stocks that are holding up well, and you go that route. And one that I've talked about several times, and I've talked about these names before, it's no coincidence, but FSLR. You take a look at the chart of FSLR. Another example of how swing trading is very difficult in this market right now. If you were buying in this upper flag, you got shaken out on a break below the bottom end of the flag. But then that was basically only a one-day event, rallied right back into the range right after that. So, just because you got frustrated on it once doesn't mean abandon it completely. And this thing's right back in this upper level range, holding up well during market weakness and showing slight relative strength today. And one that if you're patient with it, I think you'll get a breakout here at some point. I think solar technology is improving. I think First Solar is the biggest name in that group in this country and probably internationally too. I think it's potentially could lead that charge, and I think it's one that has a bright future. And technically, that story also lines up. Zillow, another one I've talked about. It held up really well during the market correction, which is step one to identifying relative strength. You like to see a stock hold up during market weakness, and then when the market does find its footing, you like to see a relatively strong stock outpace the market, on the upside, and that's exactly what Zillow did. And now what you're getting is a nice tight bull flag type pattern forming. It is a little bit whippy at times, and it can have a pretty decent range, but overall, I think you're patient with it. It is retesting this prior breakout, a decent little setup. The market, tough maybe to buy after those 6 days up, and the fact that we haven't really had a significant pull in from there. But if you're looking to buy something, I think Zillow is a tremendous opportunity. Earnings will obviously be important as it is during earnings season with any speculative stock like this. But I love the service. I love the technicals. A lot of things line up with this idea, which is exactly my sweet spot. And then GTAT. This could also be considered a little bit of an Apple sympathy type trade. Apple has poured hundreds of millions of dollars into helping GT Advanced Technologies build their factories for producing Sapphire, which is a surface that they use on the back of the camera lenses on iPhones. They also use it on the fingerprint reader on iPhones. And people talk about how it could be a leading candidate for the material that's in smartwatches that Apple could launch in the future and other wearable type devices, and then potentially as the entire screen display on an iPhone, for example. So Apple's been pouring a lot of money into helping them expand their production of that material and just overall holding up well despite any sort of sympathy idea you'd have with Apple. Above its 8 and 21 to moving average, well above its 200-day. While you've seen some speculative type stocks correct during this market pullback or this volatility that we've seen over the last few weeks, GTAT has held up extremely well. Another one that shook you out if you were trying to stay in it within this upper range, but that actually turned out to be a great buying opportunity in this market. Some of your best buying opportunities are on a shakeout type move, so you have to take a little bit of a contrarian view, but it's another one to me that's holding up really well. And then going back to a macro theme that we've talked about, flight to value. First of all, if you're sitting here trying to trade bonds and you're not an expert in fixed income, just stop it, because you don't know anything about it. Just because it's an ETF and trades on exchanges doesn't mean that you're an expert on something that it trades exactly like a stock. Same thing with commodity ETFs. People trade gold, they try to trade it technically like a stock. That is just not a smart thing to do, because it's not a stock. It's an ETF that reflects a commodity that can have volatility based on different pressures. But in terms of the TLT, I'll use it more of an indicator to help you trade stocks rather than necessarily trade it if you're not an expert in fixed income. So if you're trading the TBT, the 2 times leveraged bond ETF, which you should never have something like that in the drawer, let me be very clear, because of the mechanics of leveraged ETFs, they rebalance every night, and even if bonds do fall and yields do go up, and you own the TBT over the course of a year or a few years, you could be actually negative on that position or flat despite the trade moving in the direction you thought it was going to be. And then even with the TLT, which is not leveraged, I still think unless you have some sort of advanced knowledge on fixed income, or maybe you just want to play things at the extreme end of sentiment, which is what could have led to this bounce here at the beginning of the year. Everybody was bearish on bonds at the beginning of the year. And so when you get things, sentiment so skewed in one direction, it could lead to a bounce. But anyways, bonds are strong. And when bonds are strong, these value sectors like utilities act really well. Utilities holding up. Energy holding up well. You talk about REITs, VNQ, the Vanguard REIT ETF, above its 8 and 21 day, above its 200 day. These are sectors that had periods of weakness when tapering and stuff like that started, but since this year, since bonds have been strong this year, these type of things trade very closely with bonds, and it's pointing you in the right direction right now. So anyways, I got a little long-winded, I think, in that daily recap. I'm not sure how long this is going to run, but I think had some things that I wanted to say, get off my chest, and I said them. So overall, like I said, I think the merits of day trading is very difficult in general, but when you get an environment like this, if you're sitting here pecking away at the keyboards and trading as actively as you do in a trending market like we saw over the last couple of years, then you're not doing it right. You're not setting yourself up for success. And take the cue from people who have achieved longevity in the business and who are experienced. And you might scoff at people who take less risk sometimes because they're not putting their neck out there, and if you don't take risk, you're not going to make money. But take their cue. If they're not trading actively, if a Mark Sperling, a Scott Redler, and other people at T3 are not trading actively in this environment, don't do it. They have achieved longevity and success for a reason, and I think you'd be a fool to ignore them. I hate to use words as harsh as that, but it's just how I feel. So, take things a little slower right now. Widen your time frames and see what's going on. You're seeing a rotation of value. If you want to put money to work long term, value names are a little bit insulated from some of the volatility that we've seen, and they're the ones acting best right now. So anyways, this has been John Darcy here for the daily recap. I'll be back here tomorrow morning for the Friday morning call. I'll see you there. Look forward to talking to you again.